Ladies and gentlemen, please welcome Jason Schenker.
Great. Thank you all for being here today. It is my pleasure to address you and talk about all of the different economic inflation things that are going on. I don't want to bury the lead. I want to first talk about the most important key dynamics shaping the economy in this industry now and in the year ahead. Right now, there are some upside risks. The U.S. labor market is strong. There's a strong manufacturing and material handling backlog, and services have been contributing positively to GDP. That's the good news. The downside risks, though, are significant, and there are a number of them, right? We've seen the economy contracting. The wealth effect has reversed, where people felt really wealthy as there was the everything bubble that's now turning into the everything sell-off. More Fed policy tightening lies ahead. Year-on-year inflation rates are likely to remain elevated. Scavenger hunt economics, where you're struggling to find people, components, material, transport capacity, all of that is likely to continue. High labor costs are likely to persist, and Cold War II is here. Those are the challenges. And for those of you who want to know, we're going to go through a lot of different data. This will be available as a PDF to everyone here. So the organizers and the MHI team I partner with, they've all got that PDF ready for y'all. So you don't have to worry about taking all the pictures. You'll have it. Good. So let's talk about inflation, right? So where are we right now? So if we look at, there's a couple different kinds of inflation. Headline inflation, 8.3%, that's the blue line. Core inflation, which excludes food and energy, is 6.3. These numbers, the headline is down from a couple months ago where it was 9.1. And when it was at that level, the Fed chair was asked at a Fed meeting, what is the goal? What are you trying to do? And he said, well, we want to get inflation down to 2%. And the question was, well, which kind of inflation? There's a couple numbers here, there's other calculations, and the answer was the 9.1. That's what we want to get down to our target. Where's the target? It doesn't quite fit on the graph, it's down there, 2%. So this is going to be a bit of a struggle. And for those of you in this room who are looking at 8.3%, you're thinking, that's nothing compared to the costs I've seen, hold my beer. The actual inflation for goods manufacturers right now is still 12.2%. Now it's down from a couple months ago. A couple months ago it was 17.9%, but now it's 12.2%. Still really high. So there's still inflation in the pipeline. Is this coming down? This is a decent sign that there's downward pressure. The year-on-year rates might peel off a little bit more. This doesn't mean prices go negative. It just means prices go up at a slower pace. But they're still rising. And so the question I asked in the beginning, we're thinking hyperinflation, slowflation, stagflation. What's our situation? Last year, when we spoke, the story was growthflation, right? We had the strongest growth since 1984, the highest inflation since 1982. That story made sense, but now we're seeing the growth slow. So is this hyperinflation? And I want you to know it's not, right? So what does hyperinflation look like? So I remember the story, Germany had this in the 1920s. They had hyperinflation and the mark became worthless. There's a story about a guy goes in to buy a loaf of bread. He's got a wheelbarrow full of money. He can't get the wheelbarrow through the door. He leaves the wheelbarrow with the money outside of the store. Goes in to buy the loaf of bread, comes back out, the money's still there, the wheelbarrow's gone, right? People were getting paid on the hour. That's hyperinflation. Although some of you, and I know some industries in manufacturing, frontline workers, this June when oil prices spiked and there was the everything inflation, some folks were saying, look, if I don't get a raise today, I can't come back tomorrow. So that's already, we've seen that, although those oil prices have eased off, but those pressures are there. So what does hyperinflation really look like? Well, it looks like this. This is the Zimbabwean $100 trillion note. And I understand that MHI is still taking donations for the auction. So I have brought $100 trillion that will be added to Tony's auction for MHI. I'll bring that to Tony here at the end. It's already online, I understand, if you want to bid for it. The story around this, though, is when this bill first came out, it was worth 40 cents. Today, it's worth hundreds or thousands of dollars, depending on the quality. This is gem uncirculated, number 65. It has the documentation with it. If you bought a strap of these when they were issued in 2008, so 100 of them, it was $40. Today, because they're such collectibles, it's worth $25,000 to $35,000 if you have a strap of them. So here's the good news, bad news. So if we get a little inflation, it's just a huge pain. But if we have record-breaking inflation, there will be collectibles. So there's some other good news, which is as we look around at manufacturing, even though we've seen a slowing globally, these are the manufacturing PMIs, surveys of purchasing managers in manufacturing, break even of 50. You can see on the left the Great Recession and the drop in the US, Eurozone, and China PMIs. On the right, you can see the deep drop with the COVID recession. And now on the far right, you can see the red line is below 50. That's China. China's manufacturing is contracted in 7 of the last 11 months. China is in a manufacturing recession. The green line is the Eurozone. The last 3 consecutive months, that's been contracting, is below 50. They are very well on their way to an outright recession as well. The only line above 50 is that blue line. That's the United States. So that's the good news. This is also part of the reason why the dollar is up. Because if we look, we aggregate those 3 series, right? They each have a break even of 50. There's 3 of them. 150 is the break even. You can see the Great Recession on the left, the COVID recession on the rightish part here, and now where we are right now, the beginning of another global manufacturing recession. But right here, we still have a really big backlog. Demand is still strong, and US manufacturing is still expanding. Globally, we've seen the Baltic index fall sharply. This is the historic numbers. You saw the spike we'd seen in the last year and a half. That's now come off. This is a proxy for shipping costs. Steel prices, those have come down very sharply this year. This is the prompt month contract, currently at $790 a ton. It was $1,600 just a few months ago. Steel prices have come off. So if you have that backlog and you've been playing scavenger hunt economics, your shipping costs are now a bit lower, and your steel prices are quite a bit lower. There's another piece of good news, which is jobs. If we look, essentially, there's not many people unemployed. And by that I mean before COVID, the unemployment rate was 3.9 in February of 2020. And if you looked just in July 2022, it was also 3.5. It went up a little bit in August, 3.7. But it went up because more people entered the labor force. That's what you want, right? You want, and by the way, if there's anybody here who has all their jobs filled and is not looking to hire people, I'm going to tell you something. Don't tell anyone around you. Everyone else is hunting. So, just to let you know. But there's more good news. There are more workers in the United States on private payrolls right this moment than before COVID and before any other time in U.S. history. Right this moment. U.S. labor force at a record all-time high right this moment, almost 165 million people. Jobless claims, they're super low. Only 193,000 people lost their jobs last week, filed for unemployment, or 2 weeks ago, data out last week. The record all-time low is 162,000, but that was set in 1968. The labor force is now 108 times larger than it was in 1968. So when we think about the size of the labor force, this is the tightest job market we've ever had. It's why things like labor costs are going up. The employment cost index up 5.7% year on year in Q2. And that's a lot, and many of you may be seeing more than this. But even though it's up 5.7, there might be more there because inflation in Q2 was up 8.6%. Now you might be thinking, there are folks coming to you, they want to be paid more, they have other job opportunities. This is really common. In fact, Pew Research shows that between April 2021 and March of 2022, people who switched jobs and went to another company, there was 60% of those got a real wage bump. But if you got a new job with your same employer, say you got a promotion, only 47% of those people got a real pay raise that beat inflation. So the thing is, what we're seeing in the labor force is, if you want to get a pay raise, many people are seeing the only way to do that is to go to a new employer. By the way, you can see from the previous year's numbers, between April 2020 and March 2021, 51% of people who switched companies went to a new employer, got real wage gains. Whereas if you stayed with the same employer and got a new job, 54% of them saw real wage gains. So it's kind of shifted. Workers are incentivized to go elsewhere. And there's lots of opportunity. The help wanted online numbers, I know we've been talking about these for a while. If you look on the right axis, it's the millions of people employed in the US economy. The left axis is this index of job postings online. That's the blue line. What you'll notice is before COVID, the millions of people employed exceeded the job postings by about 8 million. So if we take the situation where we are now, where the job postings are with that index, and we add 8 million, we get to there. But what you'll notice is the red line is currently below the blue line by about 4 million jobs. So there's really like a 12 million worker shortfall. Where did the workers go? If you look, labor force participation rates for people over 55 have not recovered to pre-COVID levels. So if you're wondering where all the people are, they probably retired. That's where the workers went. Now, yes, the labor force is different. I know you've heard my thoughts on this at the spring meeting, right? You know, in 2001, I'm sure you'll all be shocked to hear that when I finished grad school with a master's degree in German literature, I ended up waiting tables. I know you're shocked. It's okay. But today, I wouldn't wait tables, right? I'd be driving for a food delivery app or task rabbiting, or I'd be trying to make my dog, Mr. O's, a dogfluencer, right? That's what I'd be doing. I don't know why he has a Tinder picture up there. I don't ask questions. Mr. O's does his own thing. But despite all these positive things about the labor force and all the different opportunities we see, there are signs of recession, right? Technically defined, in the last 2 consecutive quarters, GDP contracted. In Q1, it was down 1.6%. In Q2, it was down 0.6%. There has never been a time in US history where we didn't have 2 consecutive negative quarters and it was not defined as a recession. That's never happened. The reason it doesn't feel like a recession, though, is because Q4 of last year was so strong. In fact, despite contractions in the past 2 quarters, Q4 was so strong that GDP right now is still stronger than it was at the end of Q3 last year. It's so strong that we're forecasting 4 consecutive declines in GDP this year, but Q4 was so strong, we might still be up year on year this year. So that's pretty wild. Next year, though, we see contractions. This year, we expect GDP will be between +1% and +1.5% for the year. Next year, we see it down -1% to -1.5%. We don't see this as a deep recession, but we see this as a wide recession. Could be another 4 or 5 quarters or more of contractions. Now, there are a couple things to counter this. The Atlanta Fed's GDP Now, most recent data out as of yesterday, shows that the Q3 GDP number could be plus 2.3%. Now, this is an adaptive model, and we don't have September data yet, but that will have an impact. The reason we are a bit more concerned is because what's happened with consumer confidence numbers. Back in June, there was a record all-time low in consumer confidence. Now, it's rebounded a little bit since then, but it's still near that record low. How low was it? This is a 70-year series, which means consumers were less confident than during the financial crisis, less confident than after September 11th and the 2001 recession. It means consumers were also less confident than when the Berlin Wall went up, during Vietnam, during the Bay of Pigs invasion, during the Cuban Missile Crisis. So consumers are super not confident right now. And they're 70% of GDP. So that makes me concerned. I'm also concerned because if we look at financial indicators like the inverted yield curve, this is it, the 10-year Treasury minus the 2-year. Well, why would the 2-year Treasury rate be higher than the 10-year? That's because you expect recession and interest rates will be cut and long-term interest rates will be lower. And what you see here is there's a break-even line of 0. The gray shaded bars, which are kind of like a taupe, I guess, the shaded bars represent recessions. And before every single one of them or during every single one of them, you have this series go below 0. It's now more negative than before the Great Recession. It hasn't been this negative since before the 2001 recession, tech bust. And that's maybe why I'm getting like 1999 to 2001 vibes, right? Like, it's not just because boy bands are back, like K-pop and the whole thing, and you know, it does make me regret not having frosted tips longer. But you know what boy bands are followed by, right? Boy bands are followed by layoffs, right? And we've seen it before. We actually can see it now. The most recent quarterly data, if you look on the left, a couple things. The red numbers are the number of employees in startups laid off in a given quarter. The blue represents the number of companies announcing layoffs in a given quarter. And what you see is the first 3 quarters of 2020, COVID outbreak, the shutdown, the lockdown, the whole thing, that's on the left. You know what's worse than that? The most recent 3 quarters. Now, I'm always happy to talk to MHI and groups like this because y'all understand business. Business is buy low, sell high, make money, right? You don't go broke by making a profit. But there are a lot of startups out there that have lived on the mantra, the more you lose, the more you're worth. When interest rates are 0, I mean, I guess you can get away with that. When interest rates are higher, that's a much tougher story to sell. You're going to see a lot more startup layoffs. You're going to see a lot more tech layoffs. And the problem will be you will have all the unemployed crypto bros you can imagine and still not enough truck drivers, forklift operators, people to work manufacturing production lines. White-collar recession, especially on the tech side. And then there's the full tilt Fed rate hikes. Talked about this in May. I was concerned the Fed was going to just go full tilt, and they did. Right now, the federal funds rate is at 2.56%. It could go up another 150 basis points by the end of the year. Where was it last year? 0.08%. This, coupled with what's going on in manufacturing and our strong jobs numbers, are why things like the dollar is up. This higher cost of interest rate has had other ripples. 10-year treasuries are now at 3.83%. Where were they last year? Half that, 1.52%. What about high yield bonds? I talked about those last year. I talked about those in May. I said I'm really worried about high yield. Right now they're at 9.5. Last year, 4.21. Yikes. 530 basis points almost. And what about those triple C and lower, highly distressed bonds, right? So triple C and lower, these are bonds, best case scenario, you lose only half your principal when you buy them. That's triple C, but there's triple C and lower. Last year, so right now 16.84%, that's certainly beating inflation. Last year was only 7.48%. You've added almost 950 basis points to this, 36 basis points. What's a few basis points between friends when we're talking about almost 17%? So the cost of money's gone up for everything. And that's why we're getting the everything sell-off. Discounted cash flow models, the business valuation models, anything equity analysts do to value a company, higher cost of capital affects the WACC, affects the entire valuation of the company. So the Dow is down, the NASDAQ's down even more. Some of the more you lose, the more you're worth thing getting hit. Gold prices are down. And then, don't forget about magic internet money, right? So fake magic internet money's taken a real hit. And as my wife always tells me, you can't spell crypto without cry. Yeah. So as you're concerned about these markets, and you're wondering, where do we go? My bigger question really is, who should be the next Fed chair? And I would like to make a proposal on this one, in advance. It's going to be a while. Jay Powell will be here for a while. But I think the next Fed chair should be DJ Pauly D. Now, for those of you who don't know him, for you young people, because Pauly D is a geriatric millennial, he actually went to high school with my brother-in-law. That's a part of the family I don't talk to. You get it. So he actually did a TV interview in April about inflation, and he didn't use the words transitory. Last August, Jay Powell used the word transitory 4 times in his speech at Jackson Hole. Now, DJ Pauly D also talked about the cost of tank tops and hair grease. I'm not kidding, this is part of the interview. So maybe that's against him, but you need a Fed chair who's serious about this. And Powell has become more serious. The most recent Fed decision was definitely one that points towards higher rates. The most recent Fed forecast, for those of you who get our emails, are quite aggressive. And by the way, if you're not getting the emails that we produce to MHI members, please ask one of the MHI folks. We'll get you on the email list. The other thing I want you to consider, too, about this is that at Jackson Hole, while last year transitory was the watchword, this year Powell sounded almost Churchillian in the war on inflation, right? There's a job to do. We must do the job. We will not stop doing the job until the job is done. The job is inflation. That's it. They have essentially one mandate right now. And that's important, but the Fed might not be able to fix everything. And that gets back to Cold War II. I know I talked about it last year. I talked about it in May of 2021. I've been concerned. Things escalated this year with a wedding of sorts, not like a happy, June kind of wedding thing, but like a Game of Thrones kind of wedding. So at the Olympics, Putin and Xi issue a joint statement in which they say there's no limit to their cooperation, that they want to defend the outcomes of the Second World War. Americans had some pretty sharp views on this, and there was a question Pew had put to people: how do you feel about their relationship? And 62% of Americans said that the partnership between China and Russia is a serious problem. In other words, they were asking, are China and Russia really here for the right reasons? And the answer, of course, is no. Russia this is the most recent map of what they're controlling in Ukraine. They've just recently annexed 4 different parts of Ukraine. I don't know if they'll be able to hold them, but the argument has been from some folks on the national security side that there's an implicit increased threat of nuclear retaliation. Because if this is Russia and not just something separate, now you're attacking Russia proper. That's messy. It's problematic. And talking about nuclear weapons with that level of casualness is a huge problem. And yet that's what China and Russia were telling us. They're going back to World War II. If that's what we're going to, the post-war period, China bigger, Russia bigger. It's not over. So let's talk about the implications of Cold War II and supply chain. Last May 2021, in the spring meeting, I noted and cited one of the reports I contributed to for the Pentagon, in which I had written about the future nexus of supply chains and national security. And in May 2021, I talked about this, and I said, no matter what, and this is true with the inflation piece as well, it's going to be very difficult to secure our supply chains going forward. And the US government's going to push more on this. I cited the list of the DoD prohibited items. Chinese technology is on the same list as diamonds from Sierra Leone and a bunch of other nefarious stuff. I predict in the next 5 to 10 years, no company operating in America will be allowed to own connected devices manufactured in China. You will not be able to buy them. You will not be allowed to use them. Also, last May, I said Chinese economic and political hegemony is spreading, which we've now seen a push towards Taiwan. The question is, what happens next? Do we end up with some kind of economic quarantine? How does that go? Around that, we also cautioned that although Taiwan had been ranked #1 for economic freedom in the world by the Heritage Foundation, we assessed a 5 to 10 year risk that Chinese economic and political hegemony would threaten Taiwan in a 5 to 10 year window about a year and a half ago. So we're quickly moving through that time window. It's why the CHIPS Act went through. It's why national security, the government, both political parties which disagree on many things seem to be agreeing very strongly on this. We also noted that there are 5 tiers for long-term relocations if you want to continue to serve the U.S. market as a manufacturer. And I underscored that if you want to only move your factories once in the next 20 years, right, the NAFTA region in U.S., very likely. We have seen a lot of reshoring and onshoring in the past year. We will see more in the years ahead. Now, as we think about the other impacts of supply chain, right, these kinds of challenges, Cold War II adds inflationary pressure, not just because it could present more disruption risk, but also because of the impact on the left here, food prices, and on the right, energy prices. Ukraine, critical for food, breadbasket of Europe. Russia, critical for energy. Nord Stream 1, the natural gas that pumps from Russia into Germany, had an explosion in the past week. How did that happen? Who knows? Happens exactly at the same time that Russia's annexing land and is a little bit in retreat in some parts of Ukraine. It definitely looks like plausible deniability, like as Jason, I, a civilian without any access to any classified information of any kind, I'm telling you, I think it looks like plausible deniability. They wanted to cut off the gas. They were thinking about cutting off the gas. I don't know how the pipeline blew up, but I have my thoughts. That presents significant upside risk to U.S. natural gas prices this winter and power prices. We've already been warning about this. This is a major risk. Russia is critical to Europe for this. And in the United States, our gas, our LNG is going to Europe to help keep them with the lights on and the heat on this winter. As we do that, our inventories right now for nat gas are low. If you're worried about propane, propane's not as big a problem. They're in the middle of the 5-year average for inventories, but inventories of nat gas are low, and we're exporting lots of LNG. And that will become more expensive and more critical for Europe. To give you some idea, and again, you'll be able to see this when you have it in front of you for a deep dive, the colors here represent how reliant different countries are on Russia for nat gas, right? So for Hungary, it's like 50%. For Germany and other parts of Europe, it's 20 to 30% or more in Central Europe. Very reliant. But now Nord Stream is shut down. Darn. Sorry, we can't send you any gas, Europe. Oops. It really gives Russia a lot of leverage. How much leverage? Between 2.5 to 3 percentage points off of EU GDP. That's how much leverage Russia has. This is data from the IMF. They did an assessment a few months ago, also being aware this is a major risk. And they said, all right, well, this could pull Eurozone GDP, depending on the country, on average, the whole EU down like 2.5 percentage points of GDP. Regardless of what else is going on in the economy. I think this is an underestimate of how bad it could be. And to give you some idea, in our worst year of the financial crisis, US GDP went down 2.9 percentage points. This could be worse than the financial crisis for Europe. So if you want to know why the euro's down, that's why. And if you're thinking, oh man, the dollar's strong, I want to go to Europe, I want to be a tourist, I'm going next week, go before it gets cold. Just saying. And people might ask, like, did anybody know about this? Yeah, everybody knew about this. Russia's greatest weapon, always, has been weaponizing the winter. They beat Hitler with it, they beat Napoleon with it, and 25 years ago, they weaponized it, exported it to Western Europe. Made Europe dependent on Russian nat gas. Cut your CO2 emissions in half, sounds great, but now you have sold yourself to the Russians. And I know this because I was working on a consulting project in Europe in 2008, early 2008. It was a Russian-German nat gas JV. I was working for a large consulting firm in Germany. And it was my job to look at the super secret 30-year contracts for the natural gas coming into Europe. It was pretty terrifying. My job was to assess all the risks, so I had to look really deep into the numbers to assess whether the organization had offset the risks, what risks existed, prioritizing it. I was a risk specialist. That was my job. This German team. German was our working language. One day an Italian partner comes to visit the team and he pulls me aside. And he says in English, to make sure I get it, he says, Jason, thick Italian accent, Jason, don't ask too many questions. And I'm like, well, why not have to ask questions? He goes, we don't want to find your body in a dumpster. So like 3 months later, I was on a project in Chicago. So, wow. And they did not find my body in a dumpster yet. So here we are. That's a true story. As for the U.S.'s view around this on China, that's turned sharply negative. Data out just last week, Pew Research survey shows that dark line that keeps rising right now. 82% of Americans view China negatively. 16% view them positively. There's almost nothing that Americans agree on more right now than this. So what's the financial market implications? First of all, money is fleeing out of China like crazy. This is various kinds of asset classes and moves of foreign flows. The important part is if you look at the right, they're negative and they've gotten worse. Foreign investors are taking money out of China. Why? Did anybody here own any Russian iShares before the Russian war on Ukraine? Well, if you did, you'd find whatever they were worth before were suddenly worth zero. If you owned a European ETF that had anything Russian in it, it's now worth zero. Now, Russia's not a big, it's a big economy, but it's not US or China sized. It's probably not a huge part of most company or institutional investor portfolios. But China is a huge part of many institutional investor portfolios. And companies, institutional investors, financial firms, companies of all stripes are now terrified. What if what happened in Russia happens in China? This is a problem. So money is coming out of China. It's why the Chinese renminbi is weakened. It's another reason the dollar has strengthened. There's also debt trap diplomacy risks because this graph, something I discussed in May, China holds 70% of all emerging market debt. So China's the bank for emerging markets. And by the way, those emerging markets, just like all the other interest rates, those costs of capital have gone up. And of course, if you're an emerging market, you're a riskier market. You probably also pay a lot more for food and energy because you're an emerging market. And that stronger dollar probably hurts you a lot more. But there's two terrifying scenarios with this. One is, what happens if China refis all the debt? Well, they'll probably want to expand soft power diplomacy, right? Get some military bases with that. Like when they pulled in their, I think it was a battleship into Sri Lanka, right? With their debt crisis going on. The second option is more terrifying, perhaps, which is, what if they can't afford to refi it because people are taking all their money out of China? And what if China's construction situation is collapsing and now they need to issue debt? This is something that's being discussed in regional provinces of China to do bond issuances with bond yields where they are now. If you're doing big bond issuances with bond yields where they are now, you desperately need the money. So what happens if they can't refi all the debt they've had? So there is an emerging market sovereign debt crisis rolling in. There are a few different impacts. Riskier credit will get more expensive. The other thing is it actually could make the dollar get even stronger and bring even more money to the US because we look even less risky compared to what's going on in other parts of the world. We've been expecting this for over a year, that there was sort of a 18 to 24 month window on this. So I'd say there's about 6 months before we kind of hit the entry point for where we've been expecting a global sovereign debt crisis, but we're already seeing cracks globally. Those are really big risks. If you ask me what keeps me up at night, all this stuff tied to Cold War II, debt trap diplomacy, this stuff could create all kinds of problems on a global basis. But in the US, we're quite lucky and things are pretty good. If we look at the material handling data, we see the weakness. Those of you who saw the BAI that came out yesterday morning, 9 a.m. Eastern, right? There was significant weakness in new orders. New orders and unfilled orders collapsed. Only 36%, by the way, this survey, every month, members of the executive committee and the roundtable contribute to this. These are simple questions. Did it go up or down? The percent number represents the percent of people who said that went up this month. So when new orders is 36%, that means 36% of respondents said their new orders went up in September compared to August. That also means 64% of respondents said their new orders went down. The good news is 64% of shipments went up in September. So shipments is still strong. So what happened here, right? And by the way, again, I know there's a lot of numbers here. You'll get to see it at the end. New orders, you can see that the blue is the monthly. The red boxes are a 3-month moving average. You can see new orders have fallen sharply recently. But shipments have gone up. The red boxes are rising on the right. 3-month moving average increases. What's going on? Allow me to share one more graph. Unfilled orders. This is now negative. Tied for the second lowest month in the 88 months of this series was the month of September. We had a monstrous backlog built up, as many of you experienced, and now we're seeing new orders fall, the backlog run off, and shipments still continue. So this is important. This is a bright spot for this industry. This will be really important for the rest of this year in 2023 for maintaining positive activity. And seeing that the numbers are reflecting this is not surprising, but also comforting to see shipments still be this solid. Inventories were also flat in September, again, having had a big buildup in the previous 18 months. The only thing that's a bit worrisome to me in the monthly business activity index is future new orders. The expectation of 12 months from now, will new orders be better than they are now? The green boxes represent a 6-month moving average. The all-time record low for that 6-month moving average is right now. So that makes me concerned that next year will be weaker than this year. But I think we look at all the data, we know next year's new orders are very likely to be weaker than now. We know the cost of capital isn't done rising. We know the economy is slowing, but shipments are something we can look to for a bright spot. There's also e-commerce. That's a solid bright spot. In Q2, all-time record high spend on e-commerce retail, $257.3 billion. Record high. Now, you might be thinking, Jason, inflation. Yes, and if we look in Q2, e-commerce as a percent of all retail was still strong at 14.5%. Now let's talk about the material handling outlook and some of the data. I'm not going to go through all the numbers in the charts and the graphs ahead, but I want you to see the trends. This is new orders. You can see very recently, all-time record highs in just the last couple of months. The most recent data we have did come down, but coming down from all-time record highs. Similar thing for shipments. Very recently, surges in shipments. Come down a little bit off those record highs, still very high numbers. Unfilled orders, very close to all-time record highs even now. Inventories, record highs right now. As we talk about the forecast, and there's a lot of numbers, don't worry, again, you're going to get these. The big thing to know is in 2022, we see record all-time highs for new orders, shipments, unfilled orders, inventories, even though we've seen some recent slowing. In 2021, we had record levels of new orders and shipments and unfilled orders and inventories. Next year, we expect it will be lower than this year, but it could still be the second best year ever. Worst case scenario, we might see the third best year ever. But it's going down, but still high. As we look at percentage changes, there's not a lot of red here. The only caveat I would share as we look at these numbers and go, wow, look how big the numbers are, is this isn't like real GDP where you pull out inflation. This is the price of everything, the nominal price. So when we see next year down 2.3%, if inflation's still 5%, you might be down 7 to 10%. Something to think about in terms of volume, not price. Still coming off all-time record highs. I'm going to leave you with a couple other things. I know people are worried about housing and consumer debt. Mortgage rates for 30-year fixed rates, they are rising fast. Home sales are falling. Interestingly, if we look, you can see on the right, even the peaks, the recent peaks we had in home sales, new single family, they never got back to where we were before the housing crisis. It's part of the reason why, even though home prices have come down, you really would need to look closely at the chart to see the price come down on home prices. Still near all-time record highs. So here's the thing. Why did home sales volume never get to before pre-housing crisis, despite the boom, despite the rise in demand, despite the increase in population, despite all the wealth created on equity markets? Why did home sales not go higher? Why did home prices not come down so much? It's because mortgage credit quality has never looked as good as it does right now. This is the data from Q2 2022. Every bar chart here represents an individual quarter in which mortgages were issued. The mountain of light blue on the right, which is almost scarce on the left side of the graph, are mortgages that had a 760 plus credit score. The blue and yellow that's very prevalent on the left and a lot of the gray, much smaller on the right. In the last 2 years, 2/3 to 3/4 of all mortgages issued were to people with 760 plus credit scores. So I have good news. We learned something from the housing crisis. We did. You look at household debt to GDP in the United States, it's around 75%. During the housing crisis, it was 100. So our debt to GDP ratio is not at a record. We are still relatively deleveraged. If I put up almost any other country, that's not the situation. Almost any other country, their household debt to GDP, that percent ratio is the highest ever right now, but not for us. Another thing that I'm quite pleased to see is that debt delinquencies are really low. Yes, the United States household debt exceeds $16 trillion. That's a lot of debt. This shows the colors represent different levels of delinquency and the percent of all the debt that's delinquent. Right now, if you look on the right, the record all-time low is right now for delinquencies. It's between 2 and 3% out of the entire 16 trillion. During the parts of the housing crisis and the financial crisis, it was almost 12%. So we are much more deleveraged than we have been in the past. So even though we face challenges, mortgage credit quality, very high. Many of these were refis at record low interest rates. Debt delinquencies are at record lows. Jobs are very strong. So just to summarize a few key things. Again, we've got some upside risks, and there are a number of downsides. But key takeaways to think about in the current environment: to focus on ROI, focus on supply chain and operational resilience. Be conservative with your spending and buckle in for potentially higher inflation than we might normally see. Even if it goes down from here, it might just take a little while to get down to 2%. It's going to be a little sticky. Preparing for those things are going to be really important for the next 2 years. And with that, I leave you the disclaimer. I know this is like your favorite part of the whole thing. And then me. And so I'm happy to open it up. We've got time for a few questions, I think. I'd love to do some Q&A. Oh, sure. Scott, come on down.
Great presentation as usual, thank you. Regarding backlog, I guess the concern for companies that don't have deposits secured and so on is cancellation. So that could obviously catch up with you real quickly. What are your thoughts there?
Yeah, thank you for the question, Scott. So last May, one of the companies I advised, not in this industry, and he told me he was worried about cancellations. They were getting record levels of orders, and I told them, look, you've got two choices. And maybe it's both, but number one, maybe some companies are placing shadow orders, right? They're being quoted in weeks, but it's like more than 52. And so maybe they're going to place multiple orders, and whoever's orders comes in first is the one they're going to keep. So you can try to get your stuff there quicker than anybody else so your order doesn't get canceled. And option two, I told him, was you need to make sure that you will be made whole if things get canceled. So in this environment, you know, that's something I'd be thinking about as well, and that's what I've told companies outside this industry to be thinking about. Other questions? We got the two microphones. I don't know if we have more than two, but I know we've got two. It looks like we might have is that a third one over there? All right, we got questions.
When do you think inflation will get to 2%?
When do I think inflation will get to 2%? It's probably a couple of years. I don't think you want to see it get there faster. It's like, it's not, they often say with markets, it's like escalator up, elevator down. This is more like escalator up, tower of terror. So,
Jason, in the spring, you talked about the risk of the food insecurity
yes.
with Ukraine war. Can you update us on that?
Thank you very much. This is actually something the IMF has had reports out constantly about this topic because Ukraine's so critical for grain production. We do see food issues around the world. The IMF is taking steps to try to help countries manage these problems. It's going to keep food inflation present longer. because no matter how many times the Fed raises rates, and I don't know, did anybody here get the s'mores yesterday at the cowboy thing? I know I did. Yeah, I see some hands. So no matter how many times the Fed raises rates, Putin and Biden and Xi and Zelensky aren't going to be sitting around a campfire making s'mores, right? Singing Kumbaya. So I am concerned that there will continue to be food insecurity. I'm also concerned we haven't seen meat prices top out because, the grain leads the price of meat. So we could see meat prices be quite a bit higher this fall, this winter. Most expensive Thanksgiving and Christmases ever, I suspect. Domestically. Internationally, it's more dire. Yep.
There's talking heads out there that say recessions are necessary in the cycle, and this one's overdue. Embrace it. What's your take on it?
So the question is, recessions are necessary and overdue, and we need it. I disagree. I think recessions are very unpleasant. Technically, mortality rates go up during recessions. I don't think they are necessary. What I do think, though, is that we need to be prepared for the challenges that are coming. Right? It's called a business cycle for a reason. I love Ben Bernanke's quote about this, that business cycles don't die of old age, they get murdered. And COVID murdered it before, and now the Fed is going to murder it. So in order to kill inflation, in order to prevent longer-term economic catastrophe. But we're making a terrible choice here. Short-term economic pain. I mean, look, there's $32 trillion has been erased from global equity markets in recent months. $32 trillion. So that's not good, seems unnecessary, but the longer-term risks of if inflation gets out of control, I'm sure y'all don't want, a future auction to be, here's an American gazillion dollar, thing going to the MHI auction, right? I think that would be less fun. So, thank you for the question. Please.
What is your forecast for the next 2 Fed fund rate increases coming this year, and what impact do you think that will have on the stock market?
Great, thank you very much. This is a tough one. I think we're going to see, so the next Fed decision is November 2nd. I think we're going to see their 50 or 75 basis point rate hike. The job number that comes out this Friday is going to be important for that. If the jobs are still good and inflation is still hot, then the Fed's going to go. The other thing is, to the point about nat gas prices this winter, if we see those prices high, that's going to be really tough for inflation to go down if you have record nat gas and power prices. Something to be aware of. And I think we very likely are going to see 50 to 75 basis points at the next 2 meetings. We've seen the impact of those higher interest rates on equity markets in the past, although past predictions are not indicative of future returns. I would tend to think higher interest rates could also further weigh on equity markets, further support the dollar, further weigh on bond prices, and send short-term bond yields higher. Please.
Jason, you've described kind of 2 ends of the spectrum for how companies like those here solve problems. So you've mentioned the tightening capital markets to invest and to take risks, and you've also mentioned the 12 million gap in folks to do the work. Those are 2 dichotomies, and I'm curious your opinion on, are investors going to be more willing to take risks to close those gaps and to provide value, or are they going to play it safe and live with the uncertainty of labor?
Thank you for the question. I think the second one is the safer option, if I'm honest. One of the things I've been talking to folks about is being careful about taking risks, because both the higher labor costs, that increases your OpEx. Well, the higher interest rates, that sends up your CapEx. All of that eats your EBITDA. If you actually need to turn a profit, you need to be very careful about managing where those last dollars go. And this is maybe not the time to doing the full stretch for the growth because things are going to slow down. So I think that's something to be very careful about. This is not the time to go crazy. Please.
For those of us who are heavily dependent on the microchip market, which is, when you say inflation, we were buying chips for $1.88. Now we're buying them at $75 a piece.
Yep.
Given the political the situation with China, can we ever expect that to calm down, or are microchips volatility here to stay?
Thank you for the question. I think the lead time on how long it takes to build the microchip facilities is the big issue. I think y'all know I'm one of the 100 CEOs on the Texas Business Leadership Council. It is the business roundtable, nonpartisan, nonprofit organization in the state of Texas. We are that affiliate. We are the 100 CEOs, and we advise state and federally elected leaders. Last year, around this time, I was in DC. We met with the Department of Commerce, and we were talking exactly about this issue about chips. And now we've seen the CHIPS Act come forward. And this is a bipartisan issue. You're going to see a lot more push towards this because the prices we have now, they could go even higher, right? 90% of the high-end semiconductor market is in Taiwan. And if China gets handsier with Taiwan, that's going to be a problem. So in general, I would think we might see prices ease. It depends on the grade of semiconductor, right? But if the geopolitical tensions get worse, the prices could go a lot higher. And that's why we're trying to build more chip manufacturing facilities here in the U.S.
Hi. Oh, over here.
There we go.
I work
Please.
for Goodwill. Goodwill is one of the largest, if not the largest, salvage broker in North America. From a commodity standpoint, where do you see some of the risk in regards to the global, just the nature of global politics at this point in regards to salvage markets? And then where do you see the opportunities on the reverse manufacturing, or reverse logistics rather, with a big push of sustainability, reshoring, and things of that sort? Do you see opportunity, or you see threat for businesses like ours, or at least at this conference? Where are the opportunities? Where we should be looking to fill in some gaps?
Sure. Thank you for the question. I don't know enough about the salvage market to really speak to that. I do a lot with the scrap metal recycling market. Is that the same thing? Yeah, so China's a big buyer of a lot of those metals. This is going to be a precarious balance. So, what's happened in the global market is you've seen a push to increase recycling. The highest value recycling comes from industrial. That's rather than the bins that we have. There's this thing called wish cycling. I'm sure we're all guilty of it. I wish this could be recycled. I feel good putting it in the bin, and then the whole bin is just unusable. An example is glass bottles. You throw your glass bottle in with the newspaper and stuff. It gets wet. It goes to a MRF, a municipal recycling facility. It's dried. So now you've got broken glass and newspaper that got wet and dried, and now it's going through a machine. That's essentially fiberglass that can cause a breakdown. So there's all kinds of problems with consumer recycled goods, but on the industrial side, we're going to see a bigger push towards sustainability. That's accelerating. I've been doing work with the scrap metal recycling industry for almost 20 years. And I would tell you, obviously, because I cover metals and things like this, the circular economy, that's all going to accelerate as companies want to reduce their CO2 footprint, and they also want to maximize access to clients and maximize the supply chain access that they'll have. In other words, rather than have things made in other places that may be more precarious going forward, if you're finding a way to have a circular move within that, that's going to accelerate as well. So I think we're going to see that just generally as a part of sustainability. But the push towards increased, if you're not doing industrial recycling, I would hope all of y'all are, because there's also financial benefits to that. That metal that you have left over, called prime, that has value to it. But you're also going to see a bigger push to sustainability going forward in the years and decades ahead. And I think this will probably be our last question. Please.
So we've heard about chips. The other side of the spectrum, cold rolled steel. Mm-hmm. This industry is very dependent, and 50% of the capacity exists in China. Is there any onshoring in that space?
Yeah, thank you for the question. So I should differentiate between some of the highly commoditized goods and some of the high-tech goods. So I'm not sure exactly how all kind of future trade conflicts play out, but this is the reason why the Section 301 and 232 tariffs that were implemented in the Trump administration were kept in the Biden administration, right? These are very different presidents, very different administrations, right? And yet, that Section 232 tariff around steel and aluminum, that's remained in place. So I think you're going to probably see a bigger push to this, and it might not necessarily be in the US, but I think NAFTA region, you're going to eventually see more capacity around this as more manufacturing reshores here to shorten up those supply chains and decouple from China more fully. And with that, I'll be around for a few minutes if y'all have any questions. And if you want to bid on the $100 trillion note, it's online on the MHI app, and I'm going to put it out there now with Tony. So thank you very much.
Very much. Thank you very much for the $100 trillion donation to MHI. So I am positive that this will open up the floodgates as we look to meet our goals. So while you're at lunch, look at your app. There's a chance to donate. It's for the scholarships for the future, talent coming into our industries, and also make sure you check out the silent auction. There's a lot of cool things out there that you guys can bid upon. And when we get together later this evening, we'll see how we're doing, and we'll make sure that Jason's donation is added to our thermometer or our barometer of donations. Thank you.
Thank you,
Thank you,
Joe.
Jason.
Thank you.